hear this every single week. I did a joint venture with my partner. I put in all the money, but I received nothing in return, and he handled everything. So that's why I did not report anything. Or we roll the profit into the next project. We made some money in the first deal. We roll all the profit into the next project. So that means I don't have to pay tax. Or I hear this, I didn't receive any statements. I can't file because I have no information. Today we're breaking this down. What a joint venture is and how to report it, and why a joint venture agreement is absolutely mission critical. And I'm going to share with you a simple real life example and a court case that shows what happens when things go wrong. Hi, my name is Cherry Chen. I am a chartered professional accountant located in Oakville, Ontario, Canada. And I'm on a mission to become the Google map for hardworking Canadians seeking financial freedom. Today, we are on this topic to help you understand what joint venture relationship means and how to prevent the potential pitfall that you may be exposed to. If you like our YouTube channel, make sure you give us a thumbs up and hit the subscribe button below so then you can stay on top of the latest tax tips. With that, let's get started. So what is a joint venture? Well, a joint venture is a group of people coming in together, teaming up to invest in a property together. It could be two people, two or more people agree to do a specific project together. It could be buying, improving, selling, or even just renting the property, long-term property together. It could be two big corporations forming a joint venture together to develop a mall. It could also be anyone forming a relationship together just for investing, operating a business. It could be anything, essentially. Now, a joint venture is usually not a separate company. It's just a form of relationship that they form together. And each person reports a proportional share of income and expenses on their own tax return as the joint venture earn the income and incur expenses. Now, a lot of the people compare joint venture with partnership. And what's the difference between joint venture and partnership? Well, partnerships is an ongoing business. Joint venture is usually one deal or a clearly defined set of deals. Alternatively, you may also wonder, like, I'm forming a joint venture. Can I just use a corporation instead of this fussy thing called joint venture? So when you set up a corporation is its own legal person with its own bank account and tax return. And a joint venture usually isn't. So you split the results over the joint venture partners. Now, the biggest difference between using a corporation versus using a joint venture relationship is that when you incur losses in this business venture, if you use the form of corporation to own this business, this venture together, the losses are trapped at the corporation level. Whereas if you use a joint venture as the form of cooperation, all the losses are basically flowing directly to the parties, to the joint venture partners, investors, financial statements for report. So essentially, you could be initially with a lot of real estate investment, a lot of the investment would be losing money at the beginning. And that extra money, that's losses, you can immediately offset it if you're investing using the form of joint venture. You would be able to report all the losses, your share of losses from the joint venture directly in your corporation or in your personal name, depending on whether you choose to use your personal name or a corporation to invest. And the other benefit of that, using joint venture relationship to invest, is the flexibility. One partner would be able to use a personal name and the other partner could choose to use their corporation to invest. A corporation and a joint venture, a corporation and a personal name could invest together, form this joint venture, and they each report their own income and expenses. Whereas if you use a corporation to invest, the corporation is the one that's reporting everything. Whether you like it or not, it is a separate legal entity. It files its own tax returns. So as you can see, joint venture relationship is providing a lot of flexibility from reporting income, absorbing losses. So all these are the flexibility that you don't see in a corporation. Now, A joint venture is a relationship, and whenever you enter into a relationship, you should always lay down the ground rule. Typically, if you set up a corporation, you would have a shareholder agreement among yourselves to make sure that everyone is on the same page. When you guys are happy, when you initially set up the relationship, you are usually on your best terms, and when you're happy, you should always lay down the terms. And this applies to joint venture investing as well. You should always set up a joint venture agreement to set down the rules and boundaries now, and also set up all the expectation. Now, it's important in the joint venture agreement to specify who brings what, including who's the investor, who brings the cash, if someone else is qualifying for the financing, who brings the credit, who's going to bring the mortgage ability, who's going to manage the contractor, and who's going to have the realtor connection, who's going to select the property, who's going to deal with the tenants, who's going to deal with, most importantly, the finances. And then you also have to decide who's going to sign the offers, hiring the trades, who's going to accept buyer offers. Of course, the purpose of forming the joint venture is to earn a profit. So when you realize the profit, ultimately when you sell the property or earn rental income or generate a business income that's coming in, how are you going to divide the profit? Because sometimes people take a passive seat and they're willing to take less return. Sometimes the reason that you are able to have the deal done is because the other person is willing to use their credit to qualify for financing. So all these factors come into play when it comes down to split of income and profit. But the most important part is that in your joint venture agreement, you need to specify the list of things that you need to do, including how you split the profit. And of course, as an accountant, this is always the most important part. Who's going to report the income? Are you going to be the one reporting the income, or is that someone else reporting the income? So the key here, the biggest lessons learned is that a simple piece of paper, joint venture agreement beats having fuzzy memories down the road. Make sure that you always have your joint venture agreement signed. Even it is plain and simple, easy to understand terms, it's always better than not having one. Of course, the ideal situation is to work with a lawyer that know your situation and lay out all the terms and conditions. But if you don't want to pay for one, or if you don't feel like taking your best friend who you are investing with to the lawyer to formalize a relationship, signing something, or even having that email acknowledgement would help later on down the road. Now, when we talk about joint venture agreement, it's also important to bring up this topic called legal ownership and beneficial ownership. This is a terminology that our practice comes across all the time. Now, the reason is because a lot of investors are not able to come up with their financing ability. So a lot of investors are maxed out on their financing, mortgage borrowing capacity. So they choose to work with their joint venture partner because the joint venture partner typically have the credit. They would be able to borrow money. They can go on title, but they don't want to do any work. So when the partner is the one that's going on title and you are the one that's actively managing the deal, you guys may be deciding to split the income 50-50. So ultimately, who's going to report the income? And this is when legal ownership and beneficial ownership comes into play. Now, maybe your doctor joint venture partner is very busy with his practice and he's not able to participate in the joint venture deal, but he doesn't mind going on title. So when he signs off on the paper, he's on paper, he's 100% owner. But you sign this joint venture agreement specifying that, hey, I am the one that's managing the property, you're the one that's on title, we're going to share the profit 50-50 in this particular example. And you know what? That's how we're going to split the profit. That's what we agree on. But the reality is that your name is not on title. His name is the only one that's on title, and his name is the only one that's on the mortgage paper as well. So then it comes down to this concept of legal ownership and beneficial ownership. In many of the joint venture agreements that our clients use, it usually specifies that the beneficial owner is both the doctor client and yourself, who is also the active management partner. Now, then it comes to so what is beneficial owner? How is it different from the legal ownership? Well, the legal title means who's on paper, who is the one signing the mortgage, who's the one signing, going on that land registry. The beneficial owner is the real owner who truly owns the value, who puts in the money and made the decisions and receiving the benefit. Think of legal title as the name on the pizza box. If you write your name on the pizza box, your name appears on the pizza box. Beneficial owner is who actually gets to eat the pizza. So CRA tax the person who ate the pizza. Now, why does CRA care? Well, CRA follows the substance. Who pays for the deposit? Who pays for the rental? Who negotiates the deal? Who receives the proceeds? Those facts point to the beneficial owner. And so, in other words, you guys can be the both beneficial owner, while the doctor partner is the only 100% legal owner. Or alternatively, your parents are the one that's signing off on the mortgage for you, and you are truly the beneficial owner because you're young, you would not be able to qualify for a mortgage, and your parents are the one going on title to help you qualify for mortgages. But the true money coming in from you personally, buying your own condo. So you would also be qualifying as the beneficial owner. Then that brings to our next question. Now that you form a joint venture relationship and you're investing in this property together, so who's going to report the income? Now that you've formed the joint venture relationship, you select the deal, you put the deal together, you sign the joint venture agreement. So who's going to report the income? Well, joint venture in itself is not a separate taxpayer, unlike corporation. So each venture is supposed to be reporting your share of income and expenses on your tax return. If you invest through your corporation, then your corporation would be the one that's reporting share of ownership interest as well as share of income and expenses. Now, reporting happens in the year that you earn the income. So if you're collecting rental income, chances are you would need to report the income and deduct your share of income and expenses. So you're also reporting the expenses as well. Now, you are selling and flipping the properties. The sale proceeds would be what you also need to report on your tax returns in the year that you realize the sale. Now, just like sometimes in situation where people would buy one property, realize a profit, and then turn around and then use the proceeds to purchase the next property. Just because as a co-venturer, you never see the profit hitting your bank account, it does not mean that you do not need to report the tax. It just means that you still need to report the sale of the first property on your personal tax return, even though there is $0 hitting your bank account. So in a nutshell, the CRA tax rule follows where the profit is, not necessarily where the cash has gone. Now, let's use an example to explain. Alex and Jamie formed joint venture together. They decided to invest in a property. So they purchased a property for $800,000 and then they did the renovation for $120,000. The closing cost is $35,000 and the sale is $1.05 million. So the profit itself is about $95,000. Now, in theory, the beneficial split, if they 50-50 equal owner, each of them would be entitled to $47,500 of profit. But then because they turn around and reinvest all the profit into the next property, the partner, Alex, the passive partner, Alex, has not received a single dime in his bank account. But then in the year of sale, Alex is still required to report $47,500 in our example on his personal tax return. Alex gets no statement and no payments from Jamie. It's still on Alex. Even if he gets no payment, no statements, no legal documents, Alex, it is still on, in the eyes of CRA, it is still on Alex to report that $47,500 on his personal tax return. He can rely on lawyer closing document, realtor paperwork, realtor emails, bank deposits, anything to come up with a number to file. It would be best, of course, if you have all the document and the documents are shared. Alex and Jamie's example was fictional, but in reality, there was a tax court general procedure hearing that happened in BC, whereby CRA was trying to audit this particular taxpayer and basically claiming that she did not report a bunch of income from flipping properties. But she was trying to contact her own joint venture partner and she was not successful. She's trying to reach this person by phone, by email, by social media. She couldn't get a hold of the active partner and she was not given any paperwork to do any of the filing. So what happened during this tax court general procedure was that the court is basically empowering CRA to require this third party to come forward with all the documentations related to the deal, so then they would be able to properly assess this female taxpayer's tax return on the sale of these flips. This also shows you how important it is to document and set expectation clearly from the upfront, from the start. Like as you can see from the court decision, CRA and the court really go after the beneficial ownership and need the paper trail. Without it, both sides are stuck. And connecting it back to what we talked about, it goes to show how important it is to document everything and even set the expectation up front clearly from the start. As a recap, joint venture is one project team up. Each person reports their own share of income and expenses, even if they get $0 cash deposited in the bank account. It does not mean that they have no rental income to report. Just because you are on the legal title, it does not mean that 100% of the income and expenses should be reported by you and you pay all the taxes. In the contrast, legal ownership does not equal beneficial ownership, and how you report is really based on the beneficial ownership structure. And a joint venture agreement is highly recommended to set the ground rules. And the court case that we mentioned earlier proved that missing records equals major headaches. So if you liked the video today, make sure you give us a thumbs up. And if you're considering forming a joint venture to purchase your next investment property, make sure you reach out and contact us at our office. Until next time, happy Canadian real estate investing.